Hello, my name is Carlos McCord, CPA, and today I have a stock analysis of Amazon. We're going to look at all the brands that Amazon owns. We're going to take a look at their fundamentals, look at their revenue and free cash flow trends, take a peek at their balance sheet, and we'll end up at a valuation to see if this is a great buying opportunity right now, or do we want to wait till we can see if we can get a lower valuation. So let's dive right into it. So first, I want to look at all of the brands that Amazon owns. So Amazon is one of the more diversified retail companies out there. We see they own Whole Foods, Ring, Audible, Twitch, Amazon Music, MGM Holdings. That I remember when they purchased that is a big deal. I'm a big James Bond fan, and as a Prime subscriber, I was excited I get to watch all the Bond movies. We have Amazon Fresh, Amazon Basics. So we see they have so many different brands bringing in revenue from many different directions. So this pretty much diversifies the business and reduces the risk of the business. If any one of these brands or areas takes a hit due to competition or economic conditions, they have other brands that can be strong and sustain the business. So this is a great sign for an investor to own a company with this many brands. Another thing I want to point out is we're seeing the trend. Amazon signs agreements for innovative nuclear energy projects to address growing energy demands. Google recently has signed a deal to work with another company to develop some nuclear energy. So energy is a very big deal now because of artificial intelligence. It takes so much energy to run these data centers. And I believe an AI ChatGPT search is 10 times the energy of a regular Google search. So as AI becomes more embedded in everything that we do, energy is a demand. It's so much more of an issue than people realize. There are coal mines that were scheduled to close that are still open because we need the energy. Think about that. We need the energy from coal mines right now to supplement artificial intelligence and all of the data usage that's being completed by pretty much by the world now. So this is a big deal. I think you're going to see this as a trend in more companies doing this, as Amazon and Google has recently done. So we're going to see more companies get involved in nuclear energy because the power grid as it stands is not enough. So let's take a look at the all-time chart for Amazon. And we see that looks like there was a great buying opportunity over the past few years in this dip here. So if you were able to get in this dip, good job. Kudos to you. I'm sure you will be happy with your choice. Also here back in the late 20 teens, have a little bit of dip there, but we see very sharp increase over the past few years relatively. Right now, the company is sitting at $1.9 trillion market cap. A beta of 1.15, which is expected. Amazon is going to be a more mature company, so I expect that beta to kind of come down over the years as they become less volatile. And they're not paying a dividend right now, so that should be, we'll see how that plays out. I think this makes sense for them as they have so much room to invest and receive higher returns on their investment. PE right now is 44, so we'll see if we like paying 44 times earnings for a company like this. So let's get into the fundamental analysis. I like to start with the business segments. So again, we talked about how diversified their revenue streams are. So let's look. They have 40% of their revenue is coming from their online store, 16% from web services, 24% coming from third-party sellers. So people who have products who are selling on Amazon, 24% of their revenue. 8% of advertising services. We're going to take a look at something else that's a little bit interesting to me there. Subscription services, so Amazon Music, Prime, Twitch, 7%. Physical store, so Amazon Fresh, Whole Foods, 4%, and other services at 1%. So that's their revenue breakdown. So basically, they are still a online retailer for the most part. And over time, I believe you'll see Amazon Web Services pick up and increase, and advertising as well. So we'll see how this company plays out in the next few years and see if Amazon Web Services takes over the online stores. Now, I wanted to show you something here. Now, I would assume that Amazon Web Services is the fastest growing revenue stream for Amazon, but it is not. advertising services is the fastest growing revenue stream, 21% growth and 24% growth over the years 2022 and 23 respectively. Amazon Web Services did grow 29% and 13%, so a little bit slow in 23, but it looks like advertising services and web services are the two that are trying to catch up to online stores. So we'll see how that goes. Now, physical stores actually did grow higher, 94.5%. That's going to be because of some of the purchases of Whole Foods, but that is not significant compared to what the others are doing. So I think advertising services, as you see, if you go on Amazon and you search for a particular product, the first 2, maybe 4 that you see, those are ads of companies that are paying to get their item seen first. So that is growing at a much higher rate than I would assume. So this is why we look at the business segments and break it down and look at the growth, because we want to understand what the business is actually doing. So let's get into revenue. So over the past 5 years, we have a 20% revenue growth. Past 10 years, 23%. So we have a slight decrease in the revenue growth, but still pretty high. Looks like all positive years, so pretty consistent revenue growth. 9% in this year. Looks like over the past 12 months, growing at only 5%. So we'll see what they do towards the end of the year to see if that increases, but still pretty solid growth, consistent growth, but slowing down over the past few years. So we'll see how that trend continues, but overall pretty good. Let's look at, let's go back, sorry. Let's look at gross margins. Gross margin, so past 10 years averaging 38%, past 5 years averaging 42%. So we see that they are becoming a more efficient business. I believe that's because of the high margins of web services and ads. Pretty much all they have to do is take money from people and make sure that their item is shown first. So that doesn't take a lot of infrastructure build to do. So that makes sense that their gross margins are starting off at 29% in 2014, are ending up at 48% right now. So solid growth, great improvement. We love companies as they grow and become more efficient. So awesome there. Let's look at free cash flow. So we see a little bit different story on the free cash flow, and I believe it's for good reason. So let's break it down. Over the past 5 years, we have a 37.8% growth. Past 3 years, 42% growth. So they're becoming more efficient as far as their cash conversion. They're bringing in cash, 1.9 billion in 2014 to 48 billion over the past 12 months, 32 billion last year. Awesome. But we see these 2 years here, 22 and 21, negative free cash flow. So why is it negative free cash flow? So let's take a look at their free cash flow statement, and I believe we can see why that is. So when a company like this, let me explain this first. Let me go back for a quick second. For a company like this, when they have positive growth, positive, then they have this negative free cash flow, negative growth. We want to look at the business and make sure it's due to discretion. I want a company, if they're going to have negative cash flow for some years, it's going to be because they choose to invest into something to help increase the value of the business versus they're losing money from operations and they can't produce a profit. But Amazon, that is not the case. So let's go to the cash flow statement really quick. And we see these 3 years. I highlighted these 3 years because I wanted you to see they went from 16.8 billion in capital spend. So this line of investments in property, plant, and equipment, it represents the required reinvestment into the business. This is how a company is going to, this line represents a company putting money into their infrastructure so that they can continue operations. So in 2019, they're at 16.8 billion. In 2020, they go to 40.1 billion. That's over a 100% increase in capital spend. Then they add another 50% off of that 40 million to get to 61 billion in spend and 63. And last year, they're at 52 billion in spend. So these are the 2 years where they had negative free cash flow. And this is their building of Amazon Web Services. They're pumping in a bunch of money to get that going. And as that grows, the capital spend should start to tail off and decrease, and they'll bring in some revenues in there. So it took a decrease in free cash flow. So pretty much your cash balances took a hit so that they can invest in that and build value for the company. So we love when a business is doing it based on discretion. In these 2 years, they got 46 billion both years from cash from their operations. So that is okay for a company like Amazon to do. If this line is positive, the cash from operations, that's good. And this line is going to be negative because it represents spend. In these 2 years, of course, they spent more than they brought in for those 2 years, but strong cash balance, strong operations, growing revenues as we saw, typically a growing free cash flow as we saw. It's pretty amazing position to be in, and they can choose to take some of that capital, put it into their infrastructure and build new products. That's the only way we want to see negative free cash flow, unless it's a startup. So that is the story there when it comes to their free cash flow. So we're happy with what we see. We understand we have these 2 negative years. So growing free cash flow, these 2 years would mean it's not consistent growing free cash flow. But again, we know that's because of investment into the business. So that doesn't frighten us. We're okay there. Looking at the balance sheet. So I like to look at debt comparing to free cash flow. How fast can a company pay off its debt? 3 to 5 years is a sweet spot. And we see right now, they're in an average position over the past 5 years of being in poor leverage because they average 11.2. Now, why is that? It's because of these 2 years that we looked at, these 2 years of negative free cash flow. Including those 2 years, we're at 11.2 years where they average where they can pay off their debt. But if you were to look at it, they've only been in a bad position, I'd say 2017 at 5.9 and 2014 at 6.4. Outside of that, they stay in pretty solid positions. Some years below 3 years here. This year below 5 years. So we like that. That's pretty good. If you take these 2 years out, they're at about 3.2 years, I believe it is. So with these 2 years that we understand, these are kind of anomalies. Looking at their trend, they're in a great leverage position. But including these 2 years, it's averages out to be poor leverage position at 11.2. But we understand sometimes we have to look beyond our averages and numbers and do an analysis and really find out where the company is. So overall, they're in good position. As you see, they bounced back with that 32 billion in free cash flow. Debt came down about 5 billion. So they can pay off their debt right now in less than 5 years. That's a good position to be in. They pay no dividends, so we're going to skip that section. Now here's another great lesson. Shares outstanding. Now, if you watch any of my other videos, I always talk about we like companies to buy back shares, take some of that extra capital, buy back shares, take shares off the table. So there's less shares remaining. Great for the remaining shareholders. That means I now own more of the company as less owners exist. The company stays the same and there's less shares. The remaining shares own more of the company. We see Amazon, they're selling shares. This is going the opposite direction in which we like. So why would a company like Amazon sell shares? If they're a strong company, they're bringing in cash flow. I'm sure management is confident they're going to bring in more cash flow in the future. Why are they not taking that money and reducing shares? Why are they selling shares and increasing the number of shareholders? We don't like this because it dilutes the current shareholders. So share count goes down. Current shareholders, we own more of the company. Share count goes up. We own less of the company. We're being diluted. So we typically don't like to see this, but a company does this for one of two reasons. If they are desperately in need of capital and it's easier to sell shares versus taking off debt, because if we go out and get debt, we are going to be subject to these terms. We got to pay interest. There's a cost to debt. If we sell shares, that's free money coming in. We're not obligated to the lender to pay them back any time. This is our cash we can use for whatever we want. So startups, you'll see them do this because they need cash. They're not producing cash flow from their operations. They need cash. A company like Amazon might do that if they're doing a big infrastructure spend like Amazon Web Services. So we can, of course, take out some debt, or we can sell some shares, use some of that money to pay down debt. As we see, they came down $5 billion in debt over the past year. So this could be a good reason for that. Also, some companies, if a company is doing that, we want them to be in a position where the shares are overvalued. We don't want a company, we don't want a company selling shares as they're doing if their share price is at a deep discount because they're not bringing in as much money as they could. Just like you, if you're a shareholder or if you're an investor, which I hope all of you are, if you're investing, you don't want to sell shares when they're cheap. You don't want to sell them when they drop. If you sell them, you want to sell them when they're higher. This company is selling shares to bring in cash. So hopefully the stock price is much higher than its intrinsic value so that the company can sell shares when they're high and buy their own shares when they're low. So at some point in the future, I'm sure Amazon is going to have a share buyback policy, and hopefully it's at a time when the shares are current, or the current time is the shares are going to be lower, much closer to intrinsic value or at a discount. Simple arbitrage. You want the management to have a share policy that makes sense. So this could make sense definitely for the Amazon Web Services and paying down debt because the debt balance did get kind of high. So this does make sense for that. Hopefully the value is much higher than the intrinsic value, the shares. So this would be kind of doubly good. So hopefully that's the case. So we'll see in a minute if we believe that the intrinsic value is somewhere close to the current price. Let's go to economic value added. So I like to look at return on capital employed, telling me how well is management handling or allocating their capital. What's the return on your debt and your equity balance? Compare that to the cost of capital. What is your interest cost and what is the opportunity cost of the capital that you could put in the market instead of putting it into your business? So the weighted cost of capital for Amazon, 5.9. A little bit below that, their return on capital of 9.9. So they're earning value, or they're creating value from their operations at about just under 4% a year for the past 4 years. That number means nothing by itself. We have to look at what their competitors are doing to see if Amazon's management is outperforming their competitors. Looking at diversified retailers, return on capital right on par, 9.89, but their competitors have a much higher cost of capital of 9.4%. So they are beating their competition at about 3.54% per year over the past 5 years when it comes to creating value in the business. So this is great for Amazon. Now, looking at the discount cash flows. So what I did is I looked at Yahoo Finance, look at analyst estimates. They're estimating at a little bit over 31% over the next 5 years. Discount rate of 10%, because if I can take my money and put it in an index fund, I can expect an average of 10%. So if I'm going to invest in Amazon or an individual stock, I want at least 10% return, preferably over. 25, I believe Amazon is a very quality business. I believe you would think that too, looking at the fundamentals that we just reviewed. And I believe if I were to sell this stock in 5 years, and buying it now and selling it in 5 years, I can probably get at least 25 times free cash flow as far as the market cap at that time in 5 years. So that's why I've had that 25 multiple there. With that said, that puts me at an intrinsic value of $48. Now, that may be baffling to some if you think, hey, this is $186 right now, current price. How are you telling me that it's only worth 48? Such a great company. Remember, we saw those shares going up. So they're diluting the value of each share. Each year they're doing that. I think that's going to be a major contributor in this valuation here. Now, again, the whole point of evaluation, the way I see it, I want to be in the ballpark. This is an art, it's not a science. It's not 2 + 2. It's my assumptions, which I've kind of walked you through how I see the business. So you see where I kind of come up with my assumptions. My assumptions land me at 48. So I like to do like a 10% spread up and down. So the fair value range right now, I would say between $43 and $53. Personally, if I'm investing in Amazon, I'm either dollar cost averaging, meaning I'm putting a little bit of money into the stock every paycheck or every month, every quarter, however you choose. I'm going to average into this stock because it is a quality business. Meaning if I'm buying it at 186, if it drops to 100, of course I'm buying it at 100. It's a quality business and it's cheaper. Buy no matter what. Don't get fearful when the stock comes down. But one thing I do like to do when I come up with a valuation that's a little bit, or I would say a way off from the current price of the stock, I would check a few other sources. I went to Guru Focus, pumped in my numbers. I came up with 57.89. So that lets me know I'm probably in the ballpark from my perspective. From the way I see it, I'm pretty much in the ballpark on their fair value. So if you are looking to invest a lump sum of money into Amazon right now, I wouldn't say don't do it, because of course I could be wrong. The Guru Focus, I could be wrong. So again, these are based on my assumptions. I'm not going to say don't do it. I'm going to say be careful if you are doing it. Maybe you want to put some money in and wait a little bit, put some money in later on, kind of average into a position. But right now, I believe Amazon is overvalued by about 74%. So let's look at the scorecard, kind of reviewing what I discussed today. Revenue and margins look great. Cash flow looks great. Balance sheet, the past 5 years, not great, averaging at 11 years to pay off their debt. Put it in orange instead of red just because we understand those 2 years of 2021 and 22. Heavy capital spend puts their free cash flow in a bad position. And right now they're at about a little bit over 4 years. So not really in a current bad position, but being fair, looking at the past 5 years, we don't want to cherry pick. We want to look at their operations over a wide range of time. That helps us reduce risk in our analysis. I'm going to give them an X there. No dividend. Shares outstanding. Shares are growing. So their share policy right now, with the combination of bringing in cash without having to pay interest on it, bringing in cash through shares versus debt, using it for capital spend for Amazon Web Services, and also based on the valuation, the stock is grossly overvalued right now. So it makes sense. That's why I gave them a check. But again, it's orange because I do like their share or their share policy right now as far as selling shares. But as a shareholder, I'm being diluted at the end of the day, whether it's good for them to sell shares or not. So that's why it's orange there. Value creation, they are beating their competitors as far as creating value. So that's a check. And valuation, a red X because the stock is grossly overvalued. So definitely a quality business. They're in the Magnificent Seven for a reason. Very diversified, consistent revenue growth, consistent margins that are growing and improving. Starting off, I think it was like 20-something%. Now they're at 48% margins. So overall quality business. If you don't like the price, this is probably something you definitely want to put on your watch list and keep an eye on it and keep learning about the business as time goes on. And potentially we should see a better valuation in the future. I still believe a recession is coming. I'm not really listening to the noise of a soft landing. I think at some point within the next year and a half or so, a recession is definitely going to hit. You can't print that much cash as our economy or as our government has printed and not expect a backlash. So that's not reasonable based on basic economic theory. So I still believe a recession is coming. So a lot of these stocks that we're reviewing are grossly overvalued. That's because a lot of the valuation came from the cash printing, the economic stimulus, the optimism versus the actual growth and projections of the company. So I believe a lot of these valuations are going to come down at some point. So if you research a company and you love it so much, great. One day you may own it. It may not be today. It may not be right for you right now. However, you can either dollar cost average with the commitment to buy as the stocks comes down to make sure you're benefiting from that strategy. And also in the future, if you were to invest a lump sum, you might want to wait for a better valuation. There's always a time in the future to buy. Either the growth of the company is going to catch up to the valuation, or the valuation is going to come down to where it kind of makes sense for the position of the business. So be patient. Patience is going to make you a great investor. Be patient, wait for the right time, invest, and then be patient and hold and allow the stock to grow and do wonders for your portfolio. So I hope you enjoyed this analysis. Don't forget to like and subscribe. I have so much more coming, and I hope to see you in the next video.